we have something that I am calling there's 3 certainties in life. Do you guys know what the 2 certainties in life are? Death and taxes, our 2 favorite. I'd rather die than pay taxes, but until then, I guess I'll just keep paying taxes. Unless you use real estate properly, they don't have to pay taxes. Okay, so there's 2 certainties in life, but I'm going to tell you today that there's actually a 3rd certainty in life. Now, somebody asked earlier, what's going to happen next quarter or next month? Will the Fed raise the rates again? Who friggin' cares, man? Who cares what's going to happen next month? Who cares what's going to happen in the next couple of months? Let's see what the certainty is in life. So we're going to come to that. All right. So I'm just going to run through a couple slides. You guys already know all of this, but I'm going to recap it really quickly just so we can set the stage for this. As you know, we already established on the stage before, global debt is blowing through the roof. It's at the fastest rate in history. As a matter of fact, it took from the founding of the United States all the way until 1981 to get to $1 trillion worth of debt. And we've just added $2 trillion in debt in the last couple of months. How cool is that? As a matter of fact, the U.S. added $500 billion in debt in less than a month. As a matter of fact, it was just in like 2 weeks, $500 billion in debt. It's accelerating at a pace that's just melting faces, if you will. We can see that as bad as it is, the chart on the right shows the CBO, Congressional Budget Office, actually projects it's going to get way worse. This is their own projection, $50 trillion in debt by the end of the decade. And I bet they do it in less time than that. Now, that's from the CBO's office, okay? So this is what they're projecting. The U.S. Treasury put out a report that called it, quote, an unsustainable path. So that's where we're going. You guys already know this, of course. All this money printing, all this debt made asset prices take off. I don't have to tell you this. Home prices, Case-Shiller Index right here, all-time highs. S&P 500, basically looking at all-time highs. You guys already know this. I'm just kind of setting the stage here. And it caused inflation to light the world on fire. You have videos of people in Canada right now that are literally crying because they can't afford food, they can't afford housing. We just saw just this week here in the United States, to pay for the median home price in the United States now requires $114,000 a year. Do you guys see that? $114,000 a year to afford the median house. The problem is the median income is only $70,000. And that is a 50% increase in just 3 years. But turns out, did anybody's income go up by 50% in 3 years? No, that's why we're seeing strikes everywhere. The auto workers, the railways, everyone's striking. No one can afford it. And it's not just the United States. It's happening all over the world. As a matter of fact, the U.S. has some of the lowest inflation in the world. Argentina, Venezuela, Lebanon, Peru. These countries are seeing triple-digit inflation because the U.S. exports all the inflation. And we can see the forecast. Somehow we're sky high where that red line is. That's the chart on the right. And somehow the forecasts are that inflation is going to be very low in the future. It's going to be interesting. We'll cover that. So you guys already know this. Like I said, I'm just kind of setting the stage here for the talk. Of course, we talked about earlier the Fed raises the rates and then lowers the rates and raises them and lowers them and increases liquidity and shrinks and grows, shrinks and grows. That's the chart on the right. That's the Fed funds rate. On the left. The chart on the right is showing the amount of banks that collapsed just this year. 3 banks collapsed this year with, it was a bigger collapse, more dollars than what happened in 2008. 25 or 28 banks collapsed in 2008 for about $300 billion. We had 3 banks collapse this year for $538 billion. That's where we're at. So I'm setting the stage. I'm talking really fast. I got a lot of ground to cover, so stick with me. Now, we're here at a real estate conference, so of course you guys already know this. I'm speaking to the choir, but real estate is taking massive hits because of this. Real estate is very interest rate sensitive, specifically in the commercial real estate market because of something called cap rates. You're trying to figure out how much money I can make, and part of that equation is what your expenses are based off of that interest expense. And what we've just seen for the first time, not the first time in history, but in a long time, is that now the U.S. 10-year Treasury, it's considered a risk-free asset because the government always pays their debt, a risk-free asset. Everyone like risk-free? Risk-free is good, right? Risk is bad. So the risk-free asset is paying more than the median cap rate. Do you guys see that chart? Why the heck would you be buying real estate and taking all that risk when you could just buy the 10-year? It's a problem. So real estate's taking a lot of hits. All right, so I set the stage real quick. So where do we go from here? That's what you guys want to know. That's why you're listening to me, probably, right? You guys want to know where we're going to go? All right. So I'm going to show you the third certainty, okay? Let me show you where we're going to go. Real quick, if you guys don't know me, Mark Moss. I did an introduction up here earlier, so I probably didn't need to put this chart. I didn't know I was going to get an introduction. I talk a lot. You see me regularly on like Fox Business or Stansberry Research or KickGo or speaking on big stages. I have a podcast, a couple YouTube channels. Just search Mark Moss. You'll find me. So I won't run through this long thing. I already told you my real estate career started really early, got my butt kicked, and why I study macro. All right. Now, let's talk about the Fed's predictable cycles. So Jeremy up here, who, again, the last time we were on a panel, we had kind of fireworks like this before, he made a great point. He talked about the cycle. So let's just look at the cycle, right? There's a very predictable cycle here. The Fed tightens liquidity. Things are going too fast. Inflation's too high. Let's tighten the cycle. How do they tighten? Well, they raise interest rates. You guys understand that? Let me explain that real quick. The iPhone, I don't know, let's call it $1,000. If Apple wanted to sell more, actually, let me back that up. So we think about money. I can take $1,000 and I can buy an iPhone with it. I would buy an asset with dollars, but we also buy dollars. You can buy money. If I want to buy an apartment building for $1 million, I don't have $1 million. I need to go buy the $1 million. How much does it cost for me to buy $1 million? Well, it's the interest rate. The interest rate is the price of the money. So now that you understand that, if an iPhone is $1,000 and Apple wants to sell more of them, what could they do? They could lower the price. If they dropped the price of the iPhone for a month to, say, $200, you think they'd sell more of them? Yeah. So when things are cheaper, you buy more of it. When things are more expensive, you buy less. So when they raise the price of money, people buy less of money. Okay? So the Fed tightens liquidity. After that starts to happen, though, the Fed tightening causes the valuation, the strength of the dollar to start going up. Because as interest rates go up, people are like, oh, I should put more money into treasuries. All that money going into treasuries makes the US dollar stronger. That sounds pretty good. The US dollar gets stronger, asset prices get weaker, oil prices go down, gold prices go down. Sounds pretty good. Sorry. Saying it the wrong way. As they go up, right? So then what happens is then risk assets start to sell off. The valuation starts to go up. Risk assets start selling off. The problem is that we're seeing right now is that they're starting to sell off risk assets and they've been starting to sell off other treasuries. Then you see USTs, US Treasuries, sell off to raise US dollars. So because the dollar has gotten so strong, other nations, namely we've seen China, Japan, are forced to sell their holdings of U.S. Treasuries so they can afford oil. They're also selling U.S. Treasuries so they can buy their currency to prop up their currency. Because the dollar has gotten so strong, it's made their currencies weak. But they can't have their currencies weak, so then they sell U.S. Treasuries to push their dollars back up. When that happens, we get dysfunction in the U.S. Treasury market. Because now we have too many people selling treasuries. So the Fed has no choice but to eventually weaken the U.S. dollar. The U.S. dollar can't get too strong. It causes all sorts of dysfunction. Now, we talked about up here on this panel, some of the functions of the Fed, full employment, stable prices. Okay, maybe whatever, sure, that's in their mandate. But really what they really care about is making sure that the liquidity in the financial system maintains. They have to keep the treasury market functioning. That's their main thing. Now, we've seen many times where it stops functioning, and that's a big problem. Now, I'll skip this chart. This sort of highlights this cycle where they raise it and lower it, raise it and lower it. Now you kind of understand why. Now, the problem that we have now, and I think Neil kind of pointed out, the problem that we have now is the massive amounts of debt that we have. And this is where things get very complicated. Remember that debt? We can see that we have $2 trillion added recently. I already told you that. Can't even keep up. 31, 32, 33, 34 trillion. Who even knows? It's going up so fast. So this starts to complicate the cycle. It complicates it in a very big way. And to make it even worse, we see the largest holders of these U.S. treasuries, Japan, China, etc., dumping them. So when the government needs more money, they have to issue treasuries, but their biggest holders, their biggest buyers of treasuries are selling them. It's a big problem. Who's going to buy it? How does the government get the money they need if no one's going to buy their treasuries, if the biggest holders of treasuries are selling them off? It's a big problem. Well, what we've seen is a massive shift in who's holding and who's buying and who's holding the treasuries. And it's an interesting shift. What we've seen is the Federal Reserve has not been buying them because they're trying to tighten. They're trying to let them roll off. So we've seen their holdings from 2022 to 2023 drop off big time. Foreign investment is down. Commercial banks, down. What we're seeing up is pension funds. What we're seeing up is mutual funds. What we're seeing up big time is money market funds. You guys love making 0% on your money in the banks, right? 0% on your money in the banks? No. So a smarter thing to do would be go buy treasuries and make 5%, right? Anybody doing that with your cash? Should be, right? So that's that money market fund went up like crazy. The problem with the people that went down versus the people went up is that the people that used to hold it, the Federal Reserve, they don't care about rates. The people that hold it today do. You move to treasuries because they're paying you more than your bank account. If they lowered the return on those treasuries to 0, would you still be buying them? Of course not. You are an interest rate sensitive holder. So are broker-dealers, and so are pension funds. And what that means is that the volatility in the world's largest asset, the risk-free asset, becomes very, very volatile. Now remember, sure, the Fed has the 2 mandates, but what they really need is they need the liquidity in the system to continue to function. They don't want the volatility, as we see in this chart right here. It's called the MOVE Index. You guys heard of the MOVE Index? The MOVE Index measures the volatility in the market. Now, what I've highlighted here, I've put a red horizontal line, and you can see when the volatility in the MOVE Index, in the bond market, gets to about 150, the Fed hits the panic button. That's the oh crap button. That's the holy crap, if we don't do something right now, the whole system melts down. Okay? And there's 3 red circles on that shows the 3 times that it's hit that number. The one on the far right is where we're at right now, hitting that line right now. Now let me show you what's happened in those 3 circles. Here we have the US dollar index. This measures the strength of the US dollar. Remember I said the dollar can't get too strong or they have to start to weaken it. So these 3 dots here are the 3 times the MOVE Index has hit that oh crap line. And you can see each time the dollar index has dropped. The Fed has interjected themselves into the market, increased the liquidity to bring the strength of the dollar back down. Now, let's see what that means for assets. These same assets, gold, S&P 500, and oil, all went up. See the relationship here. The bond market gets dysfunction. I already broke the cycle down for you. The bond market gets dysfunction. It hits the high level. The Fed hits the oh crap button, injects liquidity. The strength of the Dixie, the dollar index, drops down, and asset prices go up. Like Jeremy said earlier, it's the cycle. Knowing where you're at in the cycle, it's all very predictable. And the reason why I'm going to call this a certainty, and I'm going to get to what this third certainty is in a minute, I'm sure most of you guys are already guessing, is because there's constraints there. It's not about whatever Jerome Powell feels like right now. It's not about what Congress feels like right now. There's actual, real constraints. So, the constraints are, let's see. I don't know if I'm jumping ahead. Normally I have my things here. I'm not sure if I'm jumping ahead. The constraints are either one, they could not do anything. And they could let the whole system blow up, and they could let the government shut down, and all the bankers could go out of business, and they could give back control to the people. No nation with a money printer will probably ever do that. The other option is they print money. So we can see that this cycle keeps repeating. Here's 5 times just in recent history it's happened. 2014, you might have heard about this. It was called the Shanghai Accord. The US dollar was so strong it put the Asian nations into massive, massive danger. And so they got together and they agreed in unison to weaken the US dollar to save the Asian nations. We saw in 2018, After Jerome Powell was elected head of the Fed, he came in full of piss and vinegar. He was going to make things right. He was going to raise interest rates. He was going to normalize the system, and then the system crashed, and all of a sudden he found out, oh, shoot, I can't do that, so let's inject again. This led to the repo spike that we had in 2019. Most of you guys, well, I don't know if you're aware, you remember the pandemic in March of 2020 and the whole market crashed? You guys remember that? What you maybe don't know, we were talking about the yield curve inversion before. When the yield curve inverts, that means there's a recession coming. What you probably don't know is in September of 2019, the yield curve actually inverted. The yield curve in September of 2019 told us there was a recession coming. Sure, let's blame it on the pandemic, but in September 2019, we already saw it happening. 2019, the Treasury market already locked up. Remember what I said, they can't allow the Treasury market to lock up. What does that mean? The repo market, this is where banks trade money. This is the overnight lending rate. They trade money back and forth. Now, in September 2019, the market seized. Nobody wanted to lend money back and forth. The Fed had to interject really quick or it's going to lock up. And they put $50 billion overnight in one night to keep the whole system from locking up. Saved the day, right? No, not really. Then it was 75. Then it was 100 billion. Then it was 500 billion. Then it was 800 billion. And by July of 2020, it was $1 trillion a day they had to keep injecting to keep the system from locking up. We can continue to see March of 2020, Fed pauses the not QE that went into then super QE, which blew asset prices sky high in 2020. September 22, the Fed tightens. The Treasury had to start pulling down their TGA account, and then we saw the UK gilt crisis happen. You guys remember that in UK? They had to inject money before that whole system crashed. March of 2023, of course, three banks went out of business. We talked about that. They had to create a new funding facility called the BTFP. They had to inject liquidity instantly into the system before the whole banking system came down. Now, this is 5 times in just the last several years. This shouldn't be happening ever. It might happen every couple of decades. It doesn't need to happen. It shouldn't happen 5 times in less than a decade. So, the question that we have, that we tried to answer up here, it was the last question. We didn't actually fully get to address it. I wanted to interject, but Bronson cut me off. Thank you for that, Bronson. So I'm going to answer it right now, because I have no one to challenge me, so you're going to have to take my word for it. Are we going to have higher for longer? That's the question that's on everybody's mind, especially us as multifamily investors. We're sensitive to the interest rates. Are we going to be able to roll our buildings over and refinance them? How long are they going to hold these rates? Can they really hold them higher for longer like Jerome Powell says? The dot plot tells me that they're going to hold them long. Is that really going to be what it is? Well, we can listen to them or we can understand the constraints, the real constraints. I would rather look at the data and not someone's opinion, because we know what the Fed does. They call it job owning. They try to manipulate the market by talking so they don't actually have to do something. So what we can see here, Fed signals higher for longer. The Fed's done hiking, but higher for longer messaging gains traction. You guys have heard this, right? Fed officials expect one more interest rate hike, and they'll remain elevated for a while, right? This is what's all over the news. This is what they're trying to sell us on, right? The Fed speak, that's the job owning. Fed speak has turned decisively less hawkish in recent weeks, so they're probably not going to raise again, but it's still going to stay higher for longer. This is the narrative that they're spinning for us, but let's look at the reality of this. So let's talk about now the third certainty. We've already talked about death. We've already talked about taxes. Now let's talk about the third certainty. So how long can it really stay high for? Sure, they'd like it to stay high for a long time. In a perfect world, why not? Well, turns out there's actually such a thing called gravity. There's such a thing as real-world constraints we have to deal with. And so what we can see is that as they raise rates, as you might imagine, the interest rates go up on the debt, which means the interest payments go up on the debt. Neil talked about that, right? So we're seeing 30 trillion, 31 trillion, 32 trillion, 33 trillion going up. And as they're raising the rates, the interest payments on the debt continue to go up. As a matter of fact, the chart on the right shows the government's largest outlays. And what you can see is that the interest on the debt is now the third largest outlay that the government has. It's exceeded the defense budget. Now, you guys might not understand what that means, but let me put it into context. You guys know we're fighting a couple wars right now, potentially World War III breaking out. Russia, China, the Middle East, whatever, right? We'll get into that maybe later. But the United States spends more on its military than the next 10 countries combined. More than China, Russia, you name it, all added up together. We spend more, and the interest on our debt is even more than that. And as the rates continue to go up, so the Treasury rates, they're locked in from anywhere from 30 years, we got 10 years, 5 years, all the way down to months. So it's not all instantly due. It's not all being mark to market daily. Every time they raise rates, it doesn't raise it on everything. There's a curve to that. But it's all being reset. About 30% of the debt is being reset in the next 12 months. About 50% of it's being reset in the next 3 years. And what we can see, that little red line that we added there, is where the interest payments will be if we continue to keep the rates higher for longer. So that's obviously not going to work. Now, there's an interesting phenomenon going on right now. As high as rates are going, some reason asset prices aren't crashing. Now, you probably heard a year ago, if the Fed raises rates, then stocks have to come down because stocks can't maintain their ratio, these PE ratios of whatever they're at, 24, 25%. If they raise the risk-free rate, I mean, for sure, stocks have to come down to 16, 17, right? They have to. Well, nobody told them because they sure haven't. Typically, gold moves in lockstep with what's called the real rates. And look at that massive divergence that's happened right now. What is going on? Why is real estate staying high? Why are stocks staying high? Why is gold staying high? Why is Bitcoin pumping? And the reason why is because people are starting to realize that paper money, fake fiat money, U.S. Treasury money is worthless. Nobody wants it. It's what Ludwig von Mises, I call him the father of the Austrian School of Economics, calls the crack-up boom. If you don't know what it is, Google it later. The crack-up boom. It's when people realize that the money is becoming worthless and they don't want to hold it anymore. They'd rather hold assets. And that's what we're starting to see in these charts. As a matter of fact, this is from a few days ago. Gold is well over $2,000 now, which is the third time it's hit that resistance, and it broke through. It's a pretty big deal. All right, so back to the higher for longer. I made this a couple days ago. This chart's already outdated. The projections are not that they're going to raise rates again, so this chart's actually outdated, so let's skip past that. And now where we're at. So here we are facing war. Biden, spending like the drunken sailor he is, wants to give another $100 billion. Why not? Sure. Throw another shrimp on the Barbie. Give it a go. Janet Yellen, when asked about this, says certainly the U.S. can fight 2 wars at the same time. Ha, we're the United States. What do you think we are? Of course. Why not? Fire up that money printer, put some more ink in that, let that thing go burr, and let's print that money. But the problem is, remember, we have natural constraints. And something came out just last week that gives us a little glimpse into what's going on. Remember the Fed speak. They're trying to manipulate the market with their words, but they're actually doing something different. So what Janet Yellen said is that the debt service cost will be 1% of the GDP for the next decade. So what does that mean? So we have the total GDP times 1%. So the interest on the debt will be 1% of GDP. Now what we can see there on the chart on the right shows us that the interest expense on GDP is the orange line, has been coming down while the debt to GDP has been going up. How does that happen? That's because interest rates were going down. Falling rates obviously bring the interest expense down. You guys are property investors. If I lowered your interest rate on your building in half, that would bring your payment down. So if I have $1 trillion in debt that I have to roll over, it's at 4%, and I roll it over and I add an extra trillion at 2%, now $2 trillion costs me the same as the $1 trillion before. So it works really good when rates are going down. But how does it work when rates are going up? This is the trend of interest rates. You can see since the 70s, they've been going massively down. But how do we get to the point where, as Janet Yellen has said, if you guys don't know who Janet Yellen is, the head of the U.S. Treasury, she used to be at the Fed, now she's at the Treasury. She used to be at the San Francisco Fed board. She said it's at 1%. So how do we get to that math? Let me just walk you through a little bit of math if I can remember it. I'm used to having my notes right here. It's hard to remember these exact figures. So before the pandemic, the US GDP was growing at about 5%. That was before the pandemic. Most likely, we're going to an area of stagflation that won't see the same economic growth. But let's just say that it does. Let's just say that we sustain a 5% GDP rate. We don't go into recession. Forget the negative GDP growth. I'm talking about sustaining 5%. Let's just say hypothetically. And then let's say hypothetically that the government somehow magically balances their budget and they don't spend a deficit. Right now we're at $2 trillion deficit. That somehow also would assume that we don't have a recession. That also assumes that tax receipts stay the same. The government doesn't fight multiple wars like they're projecting. So let's say hypothetically we continue 5% growth rate and the government balances its budget. What are the odds of that? Oh, 0. Okay. Probably a little bit higher than 0, maybe 1%. Anyway, if that happened, that would bring the interest expense from about 3.8 down to about 2.5. So how do we get to the 1% that Janet Yellen said we're going to have for the next decade? How does the math work out? The only way the math works out is if we bring the interest rate down to 0.8. 0.8. So for her to be correct, and for us to average 1% of GDP on the interest expense, what we would expect from that is an interest rate of 0.8% over the next 10 years. It's the only way. We have to print the money. Now, they can choose to go bankrupt. Sure, they can choose not to fire up the money printers. They can choose to shut down. They can certainly do that. Or they can continue to print more money, spend more deficit. We can choose to go to war. We continue to buy our own bonds because China and Japan ain't freaking buying them anymore. So we can buy our own bonds. We can continue to do that. And we're also going to have to stimulate the economy. So we're going to have to lower interest rates. It's the only way. It's the third certainty in life. Death, taxes, and money printing. That's it. So that's where we're going. What does all this mean? Let me simplify this for you. What does all this mean? Okay, it means that the Fed, the Treasury, has to get the U.S. dollar strength down. The U.S. dollar is way too strong. Oil's pumping, and the price of oil pumping is causing nations like Japan and China to dump U.S. Treasuries to, one, prop up their currencies and buy energy. If they want to stop nations from dumping treasuries, then they're going to have to bring the U.S. dollar down. That's the only way. It also means that when this has happened, this has been really good for inflation assets. It's been really good. When the dollar comes down, it's good for equities, it's good for gold, it's good for oil, it's good for Bitcoin, it's also good for real estate. This is the third dysfunction in the treasury market we've seen now in just the last 12 months. We've seen 5 in a decade, and now we've seen 3 in 12 months. We know that when it hits that level on the MOVE index, the Fed's ready to hit their finger on the trigger and inject liquidity. We also know that if there's no cut to spending, if the government doesn't magically balance their books, and the only way they can do that is by cutting either defense or entitlements. So they either cut defense when we're about to go fight multiple wars, not a very good likelihood, or they cut entitlement spending, that's your pensions and your Medicare and Medicaid. So if they don't do that, the only other option is to inject liquidity. Otherwise, we'll send the U.S. into a debt spiral in massive high gear. So let me just simplify it even more. That means massive inflation, it means high liquidity, and it means low rates. That's what I see in the future. Maybe not in the next 6 to 9 months. I don't know exactly what's going to happen in the next 6 to 9 months, but I think it's pretty clear what happens 3, 6, 5, 7 years out. It's those 3. That's it. That's what I got. You can find me out there in the back. I'm out of time.